Lines for its iPhone 15 starting before dawn this morning in New York City and around the world have investors pretty happy about demand for the new phone. CEO Tim Cook, there you see him. He showed up to greet and take selfies with customers outside Apple's New York flagship store on Fifth Avenue. Shares about 10% off the all-time highs. Will megatech, though, continue to lead, or is it now time for investors to do a little course correcting? Let's get to the floor show. Joining me now, trader Keith Fitz-Gerald, who owns Apple and just bought more yesterday, and Morningstar Wealth's chief investment officer, Marta Norton, who's starting to look beyond the so-called Magnificent Seven tech stocks that have mostly led the markets higher this year. Keith, you bought more yesterday. We still have time left, just under an hour. Are you buying more today?
Well, I tell you what, I'm pretty happy with what I purchased yesterday, but I'm not going to take that off the table. You know, this is one of those companies and one of those times, Liz, where, you know, you just look at yourself, you look at what you want to accomplish, and you look at what the markets are willing to hand to you. Everybody poo-hooed Apple weeks ago because they thought demand would slack. In fact, we're seeing today exactly what I said would happen. Demand was going to be off the charts. Pre-orders are sold out. I hope I'm smart enough to buy more, and I hope I have time after we get off the air to do it.
Well, Marta is turning just a little bit. Maybe, would you call it a 1% course correction away from tech? You know, when you look at the NASDAQ, Marta, of course, it's on path for its worst week since March. But also, year to date, we know it has actually done quite brilliantly. We do have it year to date up about a lot. How's that? My computer's stretching here. But do you look at Apple and the rest of the Magnificent Seven and say, you know, trees don't grow to the sky?
You know, I think that's a good way to put it. When we're taking a look at that Magnificent Seven collection of stocks, it's not that they're not great companies. They are tremendously good companies. But I think the question that's top of mind for us is the price that we're paying for those great companies. And so we're going to look to get into areas like tech and really areas around the economy when we think there's a little bit of a price opportunity and a disconnect between the great company and the great price. And so right now, as we take a look at the market, we actually think there are opportunities in the U.S. equity market, but we're not necessarily concentrating those opportunities in tech. We think that there are in other areas of the market that unfortunately have some kind of clouds hanging over them.
Yeah, like what? We know that energy has certainly started to rear its head once again because West Texas intermediate prices have been popping pretty dramatically, Marta. So do you kind of triangulate into a certain region of the energy world?
Well, we are in energy. So U.S. broad, the broad energy complex, we're a little bit less enthused in. We've been in energy for quite some time. We're able to benefit from the appreciating prices there. But now we're concentrating within the U.S. market on MLPs particularly. So, of course, there's a nice fat yield there that boosts the kind of forward-looking return potential. But there's also some modest growth that we're seeing there, some reasonable valuations. And there's a lot more capital discipline in this space as well. So we think it's not a bad place to be. You're getting, reasonable fundamentals and also a reasonable valuation. So that is one of the areas that we're in.
Look at this. Anywhere from a 6% dividend yield to 9%, Western Midstream Partners looking pretty good. Keith, you're still actually buying some pretty interesting and potentially volatile names, and not potentially, they have been volatile. Talk about the ones that you picked up yesterday beyond Apple.
Sure. So I went straight to Palantir yesterday, which is one of my longtime favorites. That company has got all kinds of things. Excuse me, we've got, I don't know if you can hear this, we've got some F-18s just overhead our office. But we've got, after Palantir, speaking of defense stocks, I think that company is absolutely beyond the hype. It's beyond the world that everybody ascribes to it. So it's one of these great companies in the making. But it is volatile. It's not for everybody. You got to wait it out. I also went after some Tesla yesterday and NVIDIA because those are key to our economy. We're creating data at a speed that we've never seen in the history of humanity. So I want to own both of those things as well.
How do you know they're F-18s and not another jet?
Well, because we live right next to the Growler base where I see F-18s every single day, and I know how to hear them by sound because I've been listening to them my whole life.
I thought, wow, that's a pretty good skill if you can tell by the engine. Marta, high quality debt. We've had everyone from Rick Reeder come on and talk about that to Jason Katz over at UBS. What do you think about that? Is that starting to look more attractive than treasuries? Are treasuries still going to be as effective as a hedge against the equity volatility and risk that's really out there?
Yeah, it's a great question. So, most of us are multi-asset investors. So we have our equity stake, we also have our fixed income stake, and we're also looking to that fixed income stake in many ways to be a hedge, sometimes a source of income, but certainly a hedge against volatility. Now, there's anyone's guess on whether we really are in an era of higher for longer. But if we're in a period where higher for longer is kind of the normalized environment that we're operating in, our perspective is that long-dated debt is less effective as a hedge, at least historically, in that environment than people have been used to over the past decade. And short-dated debt is actually a decent place to be. So when we're thinking about short-dated debt, we are certainly still thinking about treasuries, but we're also thinking, just broadly speaking, about high-quality corporate debt in that area. I think you can get a really nice yield in that area of the market, not take on massive interest rate risk, which isn't an insignificant concern given some of the kind of lingering considerations around Fed policy. So I think that is a reasonable place to be in the fixed income market today.
And now, Keith, we're looking at the Dow, S&P, and NASDAQ back in the green at the moment. Is it time to kind of ignore the talking heads over at the Fed? We had 3 of them today. Susan Collins, we had Michelle Bowman and Mary Daly all speaking today, kind of saying the same thing. Rates will stay higher for longer. One more hike or more.
Where do you even start with this? I mean, I wish they'd take the microphone away from everybody but Chairman Powell. All they do every time they open their mouth, Liz, is introduce uncertainty. That's the one thing the market doesn't like. Now, as an investor, yes, I submit you turn the volume right off when those guys start talking. You focus on the great companies. You focus on the products that we can't live without, because that business case, the case for investing, does not change no matter what the Fed thinks. And I submit the Fed has still lost the plot. So they've already caused the next 3 crises as far as I'm concerned.
Oh, my goodness. All right. Great to have you both on this Friday. Marta and Keith Fitz-Gerald, so nice to see you.
Hi, it's Keith here. Thanks for checking out today's highlight clip. What'd you think? Did I make sense? Is there something you'd like to add? Make sure you leave a comment down below, and of course, click subscribe to keep up right here on YouTube, or sign up for the email newsletter at the link below. You can also find me on Twitter and Instagram for my real-time thoughts on markets, analysis, and a whole lot more.